Hello guys, Alex here. I'm gonna briefly and schematically show you my usual trading strategy outside of an active trade. For example, let's take this consolidation. Unfortunately, since I have an account without subscription, my market simulator only allows me to use a time frame no lower than day 1. Let's say I open the chart and see an uptrend. I'll hold off on trading and won't jump into the green candles because that could be risky. I wait for the price to start consolidating. There it is. We see a reversal pattern forming, which means the local uptrend has stalled. It's a good idea to double check this on a cluster chart. With this pattern, we'd likely see a big cluster of sell orders here. Now we can look for entry points to build the position. We see a big red volume candle that swept liquidity. And from the low, we draw a Fibonacci grid. For the high, I'm using the second candle of the reversal pattern because the last one just swept liquidity. Now we can see where the price might potentially retrace or start consolidating. Depending on my account size, let's say I have $5,000. I'm willing to allocate 200 per position, a little under 6% of my deposit. So, I set limit orders to build a long position at these levels. First limit order at the 0.3, second at 0.5, third at 0.6, and the last one at 0.7. That's 4 limit orders, $50 each. Now we wait and see where the price goes. The market maker swept liquidity from the previous high again, and the price takes out 3 of my limit orders. So my average entry is around 308. And now I have $150 in the trade. The main take profit goes near the middle of the upper mini consolidation. There's a chance the market maker might swap liquidity again. But we should not try to catch the absolute top. No greed, take small wins but often. In this case I'm not setting a stop loss because relative to my account size there's no liquidation risk. And the odds of a deep drop on this kind of market are very low. Besides the main take profit, I also set partial close for half the position. Here I'd place it between the 0.2 and 0.3 levels. Now let's watch. Perfect. The trade fully plays out. We also get a second peak, which let us draw a trend line. Now we have a clear idea of the price channel. Even though the uptrend favors longs, we can profit both ways by trading the edges of the consolidation. So here I'd immediately open short at market price, but with a tight stop sign the trend is up. The take profit is also short to maximize the odds of success. I set it at the 0.3 level. At the same time, I place the same limit orders as before to build a long position. First limit order at the same price as the short take profit. The rest accordingly 3 limit orders at $50 each. And one order still waiting at 0.7. Let's see what happens. The short closes in profit and the first limit order opens a long. Now the main take profits goes at the channel's upper boundary and the partial take profit 50% goes near the middle 0.2 fib level. Boom, 50% profit locked in. If price retraces to the entry, I add back the $25 that got closed. So after a quick profit, the position stays open with $50 margin. Price hit the second limit orders, shifting the average entry to 318, and now I have $100 in trade. I set another partial close for 50% and wait. Nice, how the position closes. Profit success and $50 margin remains. I place another limit order at the entry and at 0.5, $25 each, keeping the total margin for this position under $200. Still no stop loss for me here, just my preference. Now I have $150 in trade with a better average entry near the 0.5 Fib level. Since price is moving up the channel, I adjust the take profit slightly lower to stay within the channel's boundaries. Same for the partial take profit. Perfect. Now the full 200 position is open and the average entry is around 290. I readjust the take profits relative to the channel. The first take profit can even go at 0.3 Fib level. Half the position closes, profit secured, $100 margin remains, and the trade fully plays out. Now we see a breakout from consolidation, likely a fake out deviation. This is the third strong push to the channel's edge. Usually after the third touch, I stop trading and waiting for the next consolidation. But here, given the fake out, I might try a short with half the usual margin. Tight stop and tight take profit at 0.3. I'm okay with this short because there's an imbalance and the market maker will likely trade this area. The channel is wide, but I'd keep the take profit conservative. Profit taken, trading session over. At this point, even without price re-entry at the channel, I consider this consolidation fully traded. One touch, second, third. Down here, one, maybe two, but I avoid a third. Trying to trade here is just a gambling. Opening more longs isn't worth it. Maybe a quick shot to the lower boundary, but even that's iffy. Probably only works here because this is a simulator and we already know where the price goes next. In real trading I will not open more position here. That's really how I'd look in an ideal scenario, but like I said, we fully traded this channel and maxed out its profit potential. And here the third touch of the lower boundary. Price fails to hold. Sellers push it down. At this point Bitcoin corrected, dragging ETH and altcoins with it. So, that's basically my trading strategy, just a raw sketch. In reality, I refine my entries more carefully, checking buy-sell volumes on a cluster chart in my software. I won't explain cluster here, that's a huge topic on its own. But the strategy I just explained can already make you decent money. The key is to avoid emotions. Don't move limit orders out of fear or panic. Emotional control is the most important part of trading. You can memorize every trading courses and textbook, but if you can't control your emotions, you will blow your account. That's it for today. Drop a like if you found this useful. Subscribe, more good stuff coming. Leave comments. What do you think of my trading strategy? Ask questions and trade smart, everyone. Catch you in the next video.